Today, I'll be looking at critical retirement truths that many financial advisors conveniently ignore or overlook. Over my years in the industry, I've watched how these hidden retirement realities consistently impact clients. And that's exactly why I'm making this video today, to expose the retirement truths that many advisors won't tell, but that you absolutely need to know. Let's get right into it. What makes common retirement advice dangerous? First, you have to understand this is a young profession, right? A financial advisor not that long ago was actually a stockbroker, somebody you had to call to buy and sell your stocks for you. And as technology has improved, we've seen the evolution of advice where stockbroker has become now an advisor. And even deeper than an advisor, now we're seeing that next level financial planner, right? So instead of just somebody telling you, hey, what to buy or sell, but actually looking comprehensively at your entire situation and not just investments, but also your taxes, your estate, your insurance, your cash flow, right? This is now the evolution of advice. But you have to understand this is a young industry. This is how bad it is, right? There is not even regulation on who can call themselves a financial advisor. That is a problem, right? Literally anybody can call himself a financial advisor. It's not a protected title like an attorney is or a CPA is, right? Thank goodness there is at least an organization, the CFP board, right, that has their designation, the Certified Financial Planner designation, which, and has really become the gold standard in our industry. But it also is like the bare minimum of, hey, I have some training, I have some expertise and experience, and I'm held to an ethical code, right? It's hard to find a good advisor, right? And let me give you a quick example. Today, I went to lunch. I'm part of the Chamber of Commerce in the community where I live. And at this lunch, everybody introduced themselves, and I said, hey, I'm Thomas. I'm a fee-only financial planner, and I teach part-time at the University of Tennessee. What's unique about me is that I incorporate the heart of a teacher, the education, into my practice, and I don't sell anything, right? I have no financial incentive for somebody to take my advice or not. From that explanation, a lady approached me who runs a successful business, and she said, this is interesting. Tell me more. My prior advisor, I feel like we never got advice from him. The only thing, we heard from him once a year, and it was only, he only helped our investment account make money. That was it, but I got this entire business. I got, family complexity. I need a lot of advice. That was interesting. Yeah, it is not uncommon in our industry that somebody be purely investment focused, right? And maybe the opposite of purely investment focused is maybe purely product focused. Because the second person that came to me, they were telling me about an advisor who was purely product focused. And this person that was telling this to me, they said, yeah, as I was signing the paperwork, I looked and I saw this 6% fee, and I had to ask, and I said, well, what is this? And that financial advisor's response was, oh yeah, that's just standard. And he tried to shove it under the rug to the point that it made this person feel uncomfortable and actually back out and say, look, this wasn't very transparent. I don't understand. This doesn't seem normal to me that you're just taking 6% right off the top of my assets. Some pushback. And then the product person that calls himself an advisor went on to say, well, I only make money if you make money. So if you're not making money, I'm not making money. And whoa, red alert, that's not how it works, right? Like if they're charging an upfront commission and getting 6%, but then if they're managing assets on top of it, there is an asset under management fee. And the way the asset under management fee, they're charging you that fee, whether the account is up or down, right? They're not only making money if you're making money, right? They may make more money if you make more money. But anyways, why is this dangerous? It's the wild, wild west. Financial advisors, unprotected title. You may be talking to someone who is purely investment focused, right? And they probably have hundreds of clients, and you're getting a reactive service whenever you dial into them, or maybe you're getting an annual touch point, right? Or you're talking to somebody who's purely product focused, and they are trying to sell something to get a commission, which may be suitable for you, but it may not be in your best interests, right? So those are real problems, okay? You really want to address comprehensively your financial situation, because once you retire and step away from income from your labor, like Now you're relying on your financial capital to sustain yourself over your lifetime. That's a big decision. And if you haven't fully considered all the retirement risks around that decision, it could lead to some unpleasant adjustments as those unfold. There are a lot of really good options out there. It's just hard to distinguish them because of all the reasons that I've said, right? Because there is no title protection, because it is a young profession, because there isn't a lot of financial planning programs at public university. It's just a young profession. It's only going to get better. But yeah, I am aware of investment advisors, and they say that investment advising, there is an art and a science to investment advising. Well, I know some investment advisors that are relying heavily on the art of investment advising than the science, where they may be, when I've asked them about their process, like, how are you determining the asset allocation for your client? Getting an answer that to me just was not satisfactory. And in fact, I see that sometimes when they get to that conclusion, I've seen investment advisors who use that allocation and use it for that same allocation across all the different types of taxable accounts, not taking into consideration the taxation of those accounts, and that you may want tax inefficient assets in tax advantage accounts and tax efficient assets in your tax inefficient accounts, right? Like, for example, if you have a taxable brokerage account, you have an IRA and a Roth, I've seen, hey, we're going to be 60-40 here or 60-40 there or 60-40 here. It's like, hey, you can be 60-40 overall, but be more strategic about which investments you're holding in which accounts, right? So that, again, that's more of the science of investment advising. Along that vein, I know investment advisors where if you ask them any tax questions, they'll just say, ask your accountant. When in reality, a financial planner should be bridging the gap with the accountant and helping coordinate, the planning that we're doing to lower your lifetime taxes needs to be in coordination with your tax preparer so that it gets reported properly, right? So it shouldn't just be two separate worlds, two silos. Like, there very much needs to be a bridge, and the financial planner should be that bridge for the client and the tax preparer. Also, another place I see, advisors who are not looking comprehensively at your situation could be totally blowing up your estate plan, right? There may be some of you who have spent a lot of money on an estate plan that only works properly if it flows through probate, right? You may have spent a lot of money on an estate plan. It's a trust that's funded under the will. And so that only works if your will is probated, right? And this trust is funded through your will. Well, if you're working with an investment advisor that's not coordinating with your estate planning attorney, they may take your account and put a transfer on death designation or a payable on death designation on it when it shouldn't have that, right? We don't want a beneficiary designation, a contract law. Like, we want this to go through probate law so that your trust is actually funded. Anyways, those are common examples that I see. So what can you do about it? Okay, what questions can you ask? Like, how can you know? Like, how can you navigate the wild, wild west and prevent, these hidden risks from blowing up your financial plan? Okay, well, one, when you're working with an advisor, ask them how they're compensated, right? It's good to know, like, this shouldn't be something they're sweeping under the rug. And it's not ideal if they have a financial incentive to place one product over another. It can still be okay, but it has to be disclosed, right? It has to be what's in your best interest and disclosed. And along the lines of in your best interest, it's good to know, hey, are you acting as a fiduciary? Is this what is in my best interest? Let's say you're working with somebody who is purely investment focused or purely product focused, but you really like them, you want to stay with them. Okay, that's fine, that's great. But then you have to take the initiative to be proactive and say, hey, I've heard there are other risks in retirement I may need to address. There are other spending shocks like longevity risk or long-term care. There are other risks in retirement that you're going to want to address, right? And again, pulling from here, Wade Fowles' Retirement Planning Guidebook, super good guidebook. Chapter 2 talks all about the retirement risk. Well, you're going to have to take the initiative and be proactive to talk to your person about addressing these risks, right? Whether it's longevity risk, whether it's market and sequence of return risk, spending shocks, right? Like long-term care needs, rising healthcare and prescription costs, inflation, death of a spouse, divorce, unexpected family-related financial responsibilities, changing public policy and tax rules, business risk for annuities and pensions, not sticking to the plan, excessive withdrawal risk, tons of risks. So if your advisor is not addressing all those risks to you, like, that's a problem. Those are all hidden risks that could blow up your financial plan. And so anyways, again, this is an area you want to measure twice, cut once when you're making the weighty decision of stopping work and retiring and living off your financial capital, your assets. Now that you've seen how traditional advisor practices might not be serving your best interests, You can use this information to plan a better retirement future for you and your family. If you want me to analyze your retirement strategy and show you what your advisor might not be telling you, click the first link in the description and book a complimentary call. I'll see you in the next one.